I wanted to talk about the dichotomy going on in the venture capital world today. I've been listening in, sitting through a number of these presentations, and there's just so much excitement, so much opportunity. We spent decades getting the data available. Now we have tons of data. We have AI to digest that data. And there's a tremendous amount of opportunity and technology opportunity across the healthcare landscape. But at the same time, public company stocks in the healthcare space have crashed. Teladoc, which traded at 23 times revenue at its peak, is trading at 1.6 times revenue today. Teladoc is a $2.5 billion profitable company, and it trades at under a $4 billion valuation. Amwell, which is one of its competitors in the digital health, in the telehealth arena, had a peak market cap of almost $10 billion. Today has a $584 million market cap and has about $506 million of cash on the balance sheet. So essentially, the market is not valuing telehealth at all. And it's a very interesting dynamic. So you have a tremendous time of great innovation, and you have a tremendous time of doubt in valuations and doubt in the market. And so I'm going to talk about that a little bit today and talk about also how to navigate through these interesting times we're in. So this is a chart which you may or may not have seen. This is updated through Q1 of this year. And it shows how the average venture capital round was $11 million back in 2013 and was $40 million in 2021. A tremendous amount of capital flowed into the venture capital world, both corporates, technology firms, private equity, everyone flooded into the market, and it really kicked in about 2018. And what happened was there was a thesis here that there is a big market. Healthcare is a very large part of the GDP and is very inefficient, and there's going to be a big revolution in technology and healthcare. And so everyone flooded into the market, and what happened was the thesis was that these companies are going to be valued the same way as many other technology software as a service companies. Historically, healthcare companies had not been valued at those wide multiples. And so as people came in, they raised tons of capital because everyone was flooding in. There was a plethora of capital. And the thought was that people will exit at these beautiful valuations. But historically, outside of this small window, there really haven't been very many highly valued public companies in the healthcare technology arena. And so we're now kind of regressing to the mean. And you'll see what happened in Q1 was there was $3.4 billion raised, which is still, by the way, almost double what was raised in 2013. So still a tremendous growth in 10 years. But of that, 40% was raised in 6 companies in these huge mega rounds. And so if you take that number out, the 26 million here has gone back to about 14, 15 million. So we're getting back to kind of a more normalized pace of investment. Well, why is this important? It's important because how much money you raise and the exit you have need to be, for the founder to be successful and for a company to be successful, they need to be in the same realm. If you build a company that exits for $75 million and you've invested 50, no one's really going to make any money. But if you invest in a company that sells at 75 million and you invested 5, then everyone's going to do really well. So if you're basing all of your investment theses on a beautiful, rapidly up and to the right valuation model, then you should raise a lot of capital. But historically in this space, those haven't been the exit multiples. And so wanted to talk about capital efficiency, which is what I do for at Rittenhouse. So capital was free and now it's expensive. This is a quote from Sequoia Capital when the markets crashed last year. Their advice was embrace reality, adapt quickly, the pain of discipline. So let's spend our money really methodically. The pain of that is it's very hard to do, but it's better than the pain of regret when you're like, oh, I'm out of cash and I can't raise anymore. So it's going to be painful either way. Focus on survive and then thrive. Focus on getting to profitability early on in your life. Even if it's at a $2 million run rate, 20 people and $2 million can survive, and in a tough environment, you can get through that. Raise capital only when needed. Raise it a little before needed, but don't raise 10 million if you're going to use 2 million in the next year, because if you don't grow into that valuation, you don't grow into that opportunity, you're going to regret it. And then it's just be very strategic in your spending. The typical venture fund 20 years ago was $30 to $50 million. A typical venture round was $3 to $5 million. And today that number is 3-4 times that. But today, you can grow a great technology company for so much less than you can the cloud, open source, offshore solutions, now AI that's going to help you write code, it's going to help you digest data. There's a lot of opportunities to grow a very nice company without a tremendous amount of capital. And that is the niche that Rittenhouse Ventures focuses on. I've been an investor for 20 years. I was just talking to someone in the audience. I was like, when I did my first deal in 2001, the question was whether nurses would use the internet. And that was the question. And I went to HIMSS, the big healthcare conference, and there were 400 exhibitors on the floor, and I covered it in about 2-3 hours. So the world has changed a lot in the last 20 years. But the ability to build a capital efficient company has grown tremendously over what it was 10, 20 years ago. So what do we do at Rittenhouse? We're investing as a fund over 20 years. I've been investing over 20 years. We've been investing as a fund since 2008 for 15 years. We've done 10 plus healthcare transactions and exits. We're focused on smaller rounds. So rounds of $1 to $5 million is our sweet spot. We're looking at companies between 2 million and 10 million of revenue. We like to meet companies when they hit kind of the $1 million run rate. We do coach and give out advice to everyone, and really have deep expertise in hospital software, in analytical payer software, in pharmaceutical software, and I made 2 telehealth investments in 2019, right before the pandemic, that are still doing well and are active in chronic care and remote telehealth. We're an active value investor. We always bring a true capital efficiency focus. And, you know, most of the people I meet, it says they're raising $10 million or more on their deck. And when I ask them how much do they need for the next 18 months, they tell me, I need 2 to 3 million. I'm like, well, why did you put 10 million? They're like, well, because if I didn't say I needed 10 million, no one would meet with me. So that's really the dynamic that's out there in the market. And when valuations were frothy, in which they are clearly not, I'm out in the market raising both as an investor for new deals and as an investor in my existing companies. It's a really tough market out there, and really the bid and the ask, no one really knows what the market valuations are. There are some people who are stuck in valuations from 18 months ago. There's some people who are looking at the teledoc and say you can't be worth more than 1.5x because if the public company with 2 billion, or profitable public company with 2 billion of revenue is only trading at 1.5x, how can I value much more than that? So there's a very interesting dynamic going on in the market today. And then most importantly, we're an active value add investor, so we roll up our sleeves. And most importantly, in today's market, there are a lot of companies that raised a lot of capital where the amount of capital they've raised does not match how much progress they've made. And so you kind of need a VC to go in there and do some heavy work and figure out what the right path forward is. Is it a down round? Is it a recapitalization? And having been in this business for 20 years through 2 to 3 up and down cycles, it really takes some good expertise to do that. And that's really one of the things that differentiates us. So with that, I don't know if we have a couple minutes for questions, but if we have any questions, I'd be happy to take them. Question is coming.
So, Saul, what would you say to companies who have a few $100,000 in traction, are trying to figure out the product market fit, and they're all self-funded, where would you go from here? Is this come talk to you and you'll dispense some free advice, or I run into, I'm talking about my company, but I run into a lot of folks who have gotten some proof in the marketplace, but are still trying to figure out how to get into healthcare in a scalable way and get that product market fit.
Yeah, so two things here. One is I'm happy to hear about your business and give you some thoughts, point you to some angel money if it's appropriate. The thing about healthcare is that the buyers tend to be followers, and there are only a small number of leaders in the pack. And when you knock down the leaders in the pack, the followers come relatively easy, not easy. And one of the things that huge curve of bubble investing is there are too many companies funded in many niches. So you're competing, a bunch of venture-backed companies are competing in a small niche and knocking each other out because they have large marketing budgets. That's going away as the funding compresses and people get more, rationalize their spend more. But finding the people who are the early adopters and who have a real problem and who have a real ROI. When I did my first deal, I was a software investor and then did a healthcare deal. And the ROI in software, if you brought in someone a 3x ROI in the first year, they would be like, okay, where can I sign? I'm going to save 3 times the money. The first deal I did had a 15 times ROI in the first year, and it took us, 2-3 years to get to 50 hospitals. And then when we got to 50 hospitals, we got to 500 hospitals 18 months later. So it takes time, and the rational rules of the road that might apply in other industries sometimes take a little longer. But you got to find the people who make sure you've got the pain point, the purchaser, and a process, and then you can isolate that and find 10 clients, because the first 10 are going to be really hard, but the next 20 are going to be a lot easier. So I'm happy to, I don't know what you do, so I can't give you more specific advice, but happy to. Very good. Thank you very much.